Good morning, everyone. Welcome to our daily COVID-19 briefing on April 2nd. My name is Tripp VanderWal, and I'm a member of Miller Johnson's Employee Benefit and Executive Compensation Practice Group. I am joined by my partner, Frank Berrodin, who is another member of the Employee Benefit Practice Group. Today, we will be discussing the employee benefit-related provisions of the recently enacted CARES Act. Like normal, before we get started, I would like to thank you all for joining us this morning. We appreciate you taking a few minutes to join us on what we anticipate will be another busy day for everyone. As it's been stated before, Miller Johnson is committed to working together with our clients, the government, community organizations, and other professionals to help us all navigate the crisis created by this unprecedented COVID-19 pandemic. The questions and feedback that we receive from these daily briefings are great because they allow us to tailor our advice to fit the practical concerns that you are all addressing on a daily basis. Here are some brief headlines from the past 24 hours before we get started. Governor Whitmer is expected to announce today that Michigan schools will remain closed for the remainder of the school year. Governor Whitmer also asked Michigan lawmakers to extend the state's current state of emergency until mid-June, but she is receiving pushback from lawmakers with that request because that period is too long. Now, to be clear, that is not a request to extend the state's current stay-at-home, stay safe order. So that is a request to extend the state of emergency, not currently a request to extend the stay-home, stay safe order. President Trump stated that he is considering restricting travel to certain hotspots in the U.S., but at the same time is resisting issuing a national stay-at-home order. And globally, the number of confirmed coronavirus cases passed 950,000, with more than 215,000 in the United States and 9,000 in Michigan. The coronavirus has claimed the lives of almost 50,000 globally, with just more than 5,000 in the U.S. Of that 5,000, more than 1,300 are in New York City alone, and 337 are in Michigan. With that, we will get started. Jeff, can you move to the next slide, please? So here is a very brief agenda of what we will be covering today. I will be covering the health and welfare provisions of the CARES Act, which can be separated into two sets, provisions that relate to COVID-19, and there are also several provisions in the CARES Act that are not related to COVID-19. Frank will be addressing the retirement provision contained in the CARES Act. Next slide, please. So the first issue is diagnostic testing of COVID-19. Under the Family First Coronavirus Response Act, basically all health plans were required to cover diagnostic testing of COVID-19 as of March 18, 2020. This includes group health plans and even grandfathered group health plans. This diagnostic testing, in that diagnostic testing requirement, let me be clear, it requires these plans to cover this testing with no participant cost sharing. So that means the health plan cannot impose things like deductibles, co-insurance, or co-payments. The diagnostic testing, it is pretty much irrelevant in what setting it takes place. So the no participant cost sharing requirement is required regardless of whether the testing occurs in a doctor's office, urgent care, emergency room, or through telehealth. And this requirement also includes not only just the testing, the actual test of COVID-19, but also the evaluation. It is my understanding that if someone is demonstrating symptoms of COVID-19. They will frequently consult with their healthcare provider, often through telehealth. The provider will then conduct an evaluation, but unless the symptoms are severe enough, will not order a test, at least not immediately. It is, to be clear, that evaluation, even though there is no test administered, is still required to be provided with no participant cost sharing. Next slide, please. The Families First Coronavirus Response Act, with respect to the actual test that needed to be covered with no participant cost sharing, included only those tests that were FDA approved. The CARES Act expanded this testing requirement to include several more categories of tests. The first are tests by developers who have requested or intend to request an emergency use authorization from the FDA. Those tests need to be required with no participant cost sharing up until the test is either denied authorization from the FDA or the developer who intends to submit the request does not actually timely submit that request. Other tests are tests developed under state authorization. And finally, kind of a broad category here, any other tests that are deemed necessary by the Department of Health and Human Services are again required to be tested with no participant cost sharing. So, as plan sponsors of group health plans, what administrative requirements do you need to be worried about or at least concerned with? And the first is amending plan documents to make sure that they are covering the required diagnostic testing. If you are a sponsor of a fully insured plan, the insurance carrier will be largely responsible, if not entirely responsible, to make sure that that plan is amended as necessary to cover the required testing. However, if you are on the line and you are with an employer that sponsors a self-funded plan, you should be reaching out to your TPA to make sure that it is preparing an amendment to your plan to include the required testing services. I anticipate that most TPAs are on top of this, and from a timing requirement, the amendment should be adopted by the end of your current plan year. Next slide, please. We're getting lots of questions about participant notification requirements about the addition of the diagnostic testing with no participant cost sharing. For those employers out there that are subject to ERISA, which is essentially any employer that is not a government or a church employer, we anticipate that this the addition of diagnostic testing with no cost sharing is a material modification, triggering the summary of material modification requirement. Having said that, it is our opinion that the addition of diagnostic testing with no participant cost sharing is actually a benefit enhancement. It is not a material reduction in covered benefits or services. So the deadline to provide the SMM is fairly lengthy. It is 210 days after the end of the plan year in which the modification took effect. So, for example, if the modification is taking effect in 2020, which it is, and you have a calendar year plan year, the SMM is not required to be provided until 210 days after December 31, 2020. So this is a lengthy period of time. As a practical matter, if you distribute a new SPD during the next annual open enrollment period, and that SPD, that summary plan description, contains the required diagnostic testing in it, this will negate the SMM requirement, the summary of material modification requirement, entirely. The second issue is the summary of benefits and coverage. As a brief background, if the information on the summary of benefits and coverage changes in any way, this triggers a 60-day advance notification requirement. So a new SBC is generally required to be provided 60 days in advance of the change, and that's true whether the change is a benefit enhancement or a benefit reduction. Having said that, we have reviewed the SBC, and we do not believe that the addition of diagnostic testing with no participant cost sharing will generally require any change to the SBC as it is required to be prepared by the Department of Labor. However, we are encouraging employers to review their SBC, determine if that is in fact true in their case. If a change is required, we have kind of two opposite requirements that are butting into each other that we need to comply with. The requirement to add the required covered diagnostic testing in the advance requirement. It's our opinion that you begin covering the required diagnostic COVID-19 testing as of March 18th and distribute a new SBC as soon as possible. We are not recommending that you try to distribute the revised SBC and then wait 60 days before the covered diagnostic testing, the required diagnostic testing is covered. Again, we anticipate that the situations in which a new SBC will be required is rare. Next slide, please. There was a concern amongst employers who sponsored high deductible health plans that covering diagnostic testing, COVID-19 diagnostic testing, without imposing the high deductible health plan's minimum deductible would cause that high deductible health plan to cease being a high deductible health plan and therefore jeopardize the HSA eligibility of every participant in the health plan. Fortunately, about 3 weeks ago, the IRS issued IRS Notice 2020-15. That notice indicates that a high deductible health plan will not fail to be a high deductible health plan because it covers both the testing and treatment of COVID-19 without the application of the high deductible health plan's deductibles or other participant cost sharing. And we're going to talk about COVID-19 treatment here more in a minute, but the result of that IRS notice is that for sponsors of high deductible health plans, when you amend those plans and begin covering the required COVID-19 diagnostic testing, this without imposing the minimum deductible, this will not jeopardize any individual who was enrolled in that health plan, or I'm sorry, the HSA eligibility of any individual who is enrolled in that high deductible health plan. Next slide, please. Payment. The CARES Act also addresses payment or reimbursement rates by group health plans for COVID-19 diagnostic testing. Basically breaks this guidance into two sets. The first is for group health plans that have negotiated rates with providers in place as of January 27, 2020, which was the retroactive date that the Department of Health and Human Services declared a public health emergency for the entire United States. So for plans that had a negotiated rate with providers in place as of January 27, they may rely on that rate to pay as far as a reimbursement rate for the required diagnostic tests through the entire duration of the public health emergency. Group health plans that did not have negotiated rates with providers or with a provider on that date must pay the cash price for the diagnostic test that is published by the provider of that test on a publicly accessible website. On a related note, the CARES Act actually imposes a requirement on the providers of diagnostic tests to publish this cash price on a publicly accessible website, and the failure to do so may result in cash penalties or monetary penalties to the provider. There is the group health plans in this situation are allowed to negotiate a lower rate with the provider, but cannot negotiate a higher rate. Next slide, please. So as I indicated, we're also going to discuss the treatment of COVID-19 by group health plans. And to be clear, a group health plan may impose cost sharing on the treatment of COVID-19. So unlike the diagnostic testing of COVID-19, the treatment for a participant who tests positive and needs to be admitted to the hospital, cost sharing may be imposed on the participant in that situation. A group health plan certainly could voluntarily waive cost sharing in these situations. Again, for high deductible health plans, this would not jeopardize a high deductible health plan's status, but again, you should work with your carrier or provider to make sure that the plan is amended to provide this treatment with no participant cost sharing. Whether or not treatment of COVID-19 will be covered by most health plans, we believe that it will. HHS has indicated that treatment of COVID-19 is considered to be an essential health benefit, either under the hospitalization requirement and or the prescription drug requirement, depending on the services that are required. Fully insured plans issued in the small group market and individual policies issued in the individual market are required to provide all essential health benefits. So these plans will definitely cover the treatment of COVID-19. And most fully insured group health plans in the large group market and self-funded group health plans cover most essential health benefits. And as a result, we anticipate they too will likely cover the treatment of COVID-19. There is one exception for you employers out there that may sponsor what we call a minimum essential coverage, or MEC only, or skinny self-funded plan. These are plans that basically only cover the required preventive care services under the ACA. Those MEC only plans are likely not going to cover the treatment of COVID-19. Next slide, please. Telehealth and high deductible health plans. So as I indicated previously, all group health plans, grandfathered or not, including high deductible health plans, are required to provide diagnostic testing with no participant cost sharing to comply with the Family First Coronavirus Response Act as amended by the CARES Act. And it is our understanding that providers of telehealth services find it difficult, if not impossible, to determine whether a telehealth service is provided for the required COVID-19 testing or for generally any other medical service. For example, I call up because I have some other affliction or a rash or whatnot, something that can be diagnosed through telehealth and not in person. As a result, most carriers were simply just covering all telehealth services with no participant cost sharing to make sure that they complied with the FSCRA. Again, this caused some concern for employers that sponsored high deductible health plans because it appeared that, at least with respect to the non-required COVID-19 testing, covering telehealth or all telehealth services without imposing the high deductible health plan's minimum deductible would jeopardize the health plan's high deductible health plan status and therefore may render participants in that health plan to be ineligible for HSAs. Fortunately, the CARES Act indicated that for high deductible health plans for plan years beginning on or before January 2022, coverage of all telehealth services or other services in remote settings without imposing the plan's minimum deductible is permissible by high deductible health plans. In other words, it will not jeopardize the high deductible health plan status as a high deductible health plan, and therefore will not jeopardize the HSA eligibility of anyone enrolled in that high deductible health plan. Next slide, please. COVID-19 preventive care services. For those of you on the line, you are may be familiar that the Affordable Care Act generally requires non-grandfathered group health plans to provide certain preventive care services on a first dollar basis, which means that the group health plan cannot impose participant cost sharing for these preventive care services. When a new preventive care service is added based on a recommendation from various federal agencies, group health plans must generally cover that preventive care service on a first dollar basis, beginning with the first plan year that begins on or after the date that is 1 year after the date that the federal agency issues the recommendation. So there is a significant time lag generally from when the federal agencies add a new preventive care service to before it has to be covered by a group health plan on a first dollar basis. With respect to preventive care services or immunizations that are related to COVID-19, there is a significantly increased timeline by which group health plans must cover those on a first dollar basis. And that timeline is based on the 15th business day after the recommendation is issued. So at this point, there has been no new preventive care services recommended by the federal agencies with respect to COVID-19. However, we anticipate that this will change in the future, especially, for example, when a COVID-19 vaccination is developed and released to the market. So group health plan sponsors will need to work with their TPAs to make sure, TPAs and insurers to make sure that these services are covered on a first dollar basis by the 15th day after the recommendation is issued. Next slide, please. Moving on to protected health information under HIPAA that is at least COVID-19 related. As a brief background, HIPAA governs the permissible uses and disclosures of protected health information by or of covered entities. And for this purpose, a group health plan is a covered entity. There's not a lot of information we have on this requirement under the CARES Act other than the CARES Act directs the Department of Health and Human Services by September 23 of this year to issue additional guidance on the disclosure of PHI that is COVID-19 related during either the public health emergency period declared by HHS or during the period of the emergency declaration by the President. Again, we don't have any other background on this requirement, but we anticipate that the guidance issued by HHS, when it comes, will somewhat relax the use and disclosure restrictions imposed by the HIPAA privacy rule with respect to PHI that is COVID-19 related during these periods, but more to come on that in the future. Next slide, please. All right, shifting gears a little bit, those were basically all of the COVID-19 related provisions under the CARES Act. As I mentioned at the beginning of my presentation, there are a number of provisions in the CARES Act with respect to health and welfare plans that are not COVID-19 related, and we will address those here in the remaining portion of my presentation. The first one has to do with the coverage of over-the-counter drugs that are purchased without a prescription. Back in 2010, the Affordable Care Act basically said that certain account-based health plans, and I'll identify those in a minute, were only allowed to cover over-the-counter drugs if they were purchased with a prescription or if it was insulin. The CARES Act removes that requirement and also indicates that certain menstrual care products can be reimbursed on a tax-free basis by these account-based health plans. And that begins as of January 1, 2020. So this new provision is actually retroactive back to the first day of this calendar year. Next slide, please. So these account-based health plans include health savings accounts, health flexible spending accounts, or FSAs, health reimbursement accounts, and Archer medical savings accounts. So again, if you are a participant in any of these accounts, at least it is now legally permissible for you to use those accounts to purchase over-the-counter products, over-the-counter drugs and medicines, even if those drugs or medicines are not purchased using a prescription from a provider, and other certain menstrual care products. With respect to FSAs and HRAs, and employer sponsors of these arrangements may cover these items, additional items, but it's optional. For those employers that would like to expand their FSAs and HRAs to cover these items, this will likely also require a plan amendment. So you should work with your HRA or FSA third-party administrator or the entity that prepares the document governing these plans to prepare the necessary amendment. With respect to participant notification requirements, the same analysis would apply that I discussed with respect to COVID-19 diagnostic testing, meaning that this is likely to be considered a summary of material modification. But again, since this is a benefit enhancement, we anticipate the deadline for that SMM would be 210 days after the end of the plan year in which the change took effect or was adopted. And therefore, as long as you issue a new SPD for the FSA or HRA during the next annual open enrollment period, this is likely going to negate the SMM requirement. Next slide, please. Interestingly enough, the government responded to a request that's becoming increasingly popular by employers, and that was the ability to reimburse employees for student loan payments. This is addressed in the CARES Act, but only on a very, very temporary basis. So under the CARES Act, beginning March 27, 2020, which was the enactment date of the CARES Act, until the end of this calendar year, and employers can use an educational assistance plan under Section 127 of the Internal Revenue Code, which are typically used to reimburse employees for currently incurred tuition and costs. They can use those educational assistance plan to also reimburse employees for student loan payments incurred between March 27 and December 31 of 2020. There are significant limitations to this arrangement. First, the only student loan payments that can be reimbursed are qualified education loans, which means that the proceeds of the loan were only used for tuition fees, room and board, books, supplies, transportation, and other miscellaneous expenses. Using myself as an example, I went to school for a number of years and therefore have a number of student loans that are in repayment. However, I often used portions of the proceeds of my loan to pay for off-campus housing, car payments, other needs that arose while I was a student, and therefore none of my loans are actually qualified education loans. So if any of the proceeds are used for these non-educational purposes, this essentially, for lack of a better term, takes the entire loan. It's unclear how employers are going to know whether or not a loan payment is for a qualified educational loan. Having said that, a borrower is required to certify, I believe, annually to lenders that the proceeds of the loan were in fact used for only these purposes and it was a qualified loan. As a result, employers may want to consider requiring the same certification from their employees before reimbursement is made under an educational assistance plan, or at least require a copy of the certification that the employee provided to his or her lender. Next slide, please. Again, at this point, only loan reimbursement payments that are due between March 27, 2020 and December 30, 2020 can be reimbursed. Educational assistance plans in general can only reimburse expenses up to $5,250. So that limitation would also apply to loan reimbursements. And if I am otherwise incurring other tuition expenses that are being reimbursed under the educational assistance plan, those expenses would be combined with any loan payment reimbursements for purposes of determining when the $5,250 limitation is reached. Because of employer cash flow issues that we understand many are having right now, the limited duration of this arrangement, essentially ending on December 31, 2020, the limited amount, again, capped at $5,250, and the fact that these reimbursements can only be made for qualified loans, qualified education loans, we at this point are not sure how much traction that these arrangements are going to be for employers. Having said that, this at least shows some willingness of Congress to explore the idea of allowing employers to reimburse employees for loan payments on a tax-free basis. So it is possible that later legislation expands, at least with respect to the duration of these types of arrangements, or maybe even loosens these restrictions. So it'll be interesting to see what, if anything, happens with that. Next slide, please. Last topic of my topics for today, again, is somewhat PHI HIPAA related. So to give a little background, substance use disorder information that is contained in patient records that are created by providers that receive federal financial assistance are subject to the confidentiality of substance use disorder patient regulations. Similar to the HIPAA privacy rule, these regulations govern the permissible use and disclosure of information contained in these records. These regulations were originally published in the 1970s, well before HIPAA ever existed, and have been periodically revised since the 70s. These regulations generally permit a provider to disclose, with the patient's authorization, certain information to third-party payers like group health plans, which of course is necessary if the group health plan is going to pay for those services by the provider. Having said that, the regulations did prohibit redisclosure by the third-party payers. This created a number of problems for group health plans. For example, if the group health plan received the information from the provider, it was technically not allowed to redisclose that information, even in a way that complied with HIPAA, to the plan's third-party administrator for the purposes of processing and paying claims. So clearly, this presented group health plans with an operational problem. Next slide. The Substance Abuse and Mental Health Services Administration, the agency that governs these regulations, recently amended these regulations for a number of reasons, and a number of public commenters asked the administration to align these regulations with HIPAA. In other words, to prevent covered entities like group health plans to use and disclose this information, this substance use information contained in these patient records in any way that was permissible under HIPAA. This administration claimed that it did not have the statutory authority to do that, but looked for other ways to address this issue. Where they landed was that third-party payers, again, including group health plans, were permitted to redisclose this information to contractors and subcontractors, again, which appear to include an insurer or a TPA, as long as there was a contractual requirement between the parties that required the subcontractor or contractor to comply with these confidentiality of substance use disorder regulations. The contract requirement was effective February 2 of this year, So I know that we, along with our clients, have been working on amending, for example, business associate agreements between group health plans and TPAs to address this contractual requirement. Next slide. So the change made by the CARES Act actually addressed the concerns that the administration had that it didn't have the statutory authority to issue regulations that align the permissible use and disclosure with the HIPAA privacy rule, because the CARES Act amends the statutes from which these regulations are promulgated to align those statutes with the HIPAA privacy rule. So from a high-level overview, as amended, these statutes are aligned with HIPAA, and the use, disclosure, and redisclosure of this substance use disorder information will be permissible under these laws as long as it complies with the HIPAA privacy rule, including the breach notification requirement. These statutes are effective March 27, 2020, and also require the administration to issue new regulations. So what does that mean? It means that arguably we should still amend BAAs retroactive to February 2, 2020 to address the contractual requirement between third-party payers like group health plans and their TPAs, but these contractual requirements are likely only to apply until March 27 of next year. Next slide, please. And with that, I will kick it over to my partner, Frank Berrodin, to address the retirement provisions of the CARES Act. And as he's addressing that, I will try to address some of the questions that we've gotten online, and we will try to address, as time permits, some questions at the end of Frank's presentation. Frank?
Thanks, Tripp. So yeah, I'm Frank Berrodin, and even though I am much older than Tripp and have been practicing a lot longer, he is actually a veteran at doing these webinars, and I'm a rookie. This is my first one. I've always preferred to do them actually in person, but we have to all learn new things as a result of this situation we're in. And so I'm learning how to do one of these from my ping pong table. So I apologize in advance for any mistakes I make in the presentation. But in general, next slide, please. I am going to be covering a couple of things that the CARES Act did in the retirement plan world. And I'm not going to go too heavy into some of the details. Hopefully, if you have specific questions, you will ask them and we'll be able to answer them. But if you've been following, the internet and all the publications out there, there's obviously been tons of information about these new rules. And the interesting thing is that everyone you look at may take a little bit different spin on them and or interpretation of the rules, which in my mind makes this kind of a very dangerous area right now, because people are trying to do things very quickly and we don't have the typical kind of guidance that we would have in the retirement world before proceeding. So the overall theme that you'll hear from me is I'm trying to get everybody to slow down a bit on making decisions about some of these new rules, whereas a lot of the large record keepers and TPAs and things are pushing people to make very quick decisions about what they're going to offer. And so we'll talk a little bit about why I think there's some reasons not to do that and to maybe take a step back. So there's really three things I'm going to cover. The new rules about voluntary distributions from the plan, new rules about loans from plans, and minimum required distributions from plans. Next slide. Next slide, please. So the plan distribution rules, they have now changed, and they now allow distributions of up to $100,000 to be made until December 31, 2020. And interestingly, when they finalized the act changed it a little bit from the initial draft. They made it apply to any distributions after January 1, 2020 through December 31. So some people may have already taken distributions that could qualify for this. And, so the tax reporting for those probably, wouldn't be done until after the end of the year, so that they may be eligible for some of these favorable things that would also cover distributions made after this time. And so one of the big uncertainties about this is these distributions, what kind of plans can they be made from? And it's very clear that they can be made from 401k plans, 403b plans, and 457 plans. And that's of both, regular taxable employers, tax exempt employers, and government employers. But what's unclear is whether they can also be made from defined benefit plans and whether they can be made from the employer contributions that have been made to defined contribution plans. When you look at the statute itself, it's a little bit it's ambiguous on that. And when you look at people's interpretation of it that's been posted in various places, they have different opinions on that. So that's one area that we need additional guidance, and you need to be careful about what is going to be allowed, what types of distributions, and what amounts. But to be eligible for one of these, the provision is very broad. Basically, a participant just has to certify that he, his spouse, or one of his dependents tested positive for COVID-19 or suffered adverse financial consequences as a result of COVID-19. And it's really the second part of that I should have put in, or the participant suffered adverse financial consequences. But the reality is, if their spouse suffered adverse financial consequences, the participant probably did as well. But that is really, really broad, because it's hard to imagine nowadays or in today's world that you are not suffering some adverse financial consequences. Really, it's got to be related to your job. But still, almost everybody is either having hours cut, having pay reduced, something, and it's just got to be a participant certification. The employer doesn't have to verify any of this. So that's really broad, and it's going to cover, I would say, almost every distribution made from plans during 2020. Next slide. So, as I said, it's not clear whether these distributions can be made from pension plans, including cash balance plans. So employers that have those, it would be very favorable if they allowed those. And money purchase pension plans, it's not clear either. And the reason it would be favorable if they allowed them from cash balance plans, and one of the reasons I'm not encouraging people to be acting too quickly on this, is we know that the worst possible thing for employees to do is to have to pull money out of their retirement plan if it's invested in any asset that is now dropped in value significantly, like stocks have, and like most investments in defined contributions plans have. So if the employee happened to have a cash balance plan account that they could pull money out of first, and that money typically is invested more conservatively and probably hasn't dropped in value, that would be very preferable to taking the money out of the defined contribution plan. So we need clarification on that. At this point, the conservative thing is to say, no, that money's not available. And the conservative thing is to say that employer contributions from defined contribution plans is not available as well. That's the conservative position to take right now. The challenge is that many of the large record keepers, some of them wanted employers to respond by March 31st as to whether they were going to allow these distributions or not. And any clients that was asking me, I was telling them, no, opt out of it for right now. You can always opt back in. Distributions can be made as late as December 31 of this year. We don't have answers to a lot of these questions. If you're going to allow these distributions, you really need to make sure employees fully understand them. And there are some more complicated things that I'm going to talk about in a minute. And further, because of the other provisions of the CARES Act, it seems like there should be very few people that need access to this money immediately. You know, they may very well need it later this year, but because of the increases in unemployment and some of the other types of compensation that they can receive, hopefully they don't need this money right away. Obviously, it'd be nice if they didn't need it at all during this crisis, but that may not be the case, but some of that is too early to tell. Next slide. So the nice thing about these distributions, one of the reasons that a lot of lower paid people really get harmed by 401k plans is that they put money in, then we have a downturn in the economy, they lose their job. They not only have to take the money out and pay tax, but they have to pay the 10% penalty tax. That is being waived for distributions made during this year that qualify for the COVID distribution exception. And because that exception, as I indicated, is very, very broad, it seems like very, very few distributions made during 2020, really for any reason, even if it was really the person retired and is now just taking a normal distribution, if they could show that they are eligible for a COVID distribution under this rule, it's likely that they could avoid the 10% penalty tax. You also can repay the distribution to the plan within 3 years without being taxed on it. So it kind of gives people the ability to say, all right, I think I need this money, I'm going to pull it out, but if things turn around and get better for the next 3 years, I can put it back in. It would be the same amount, there'd be no interest on it, and you would just be able to recontribute that amount to the plan, and it's not subject to the normal limits of contribution limits for the next few years. So that's a very nice option that's available to people. If it's not repaid, it's generally treated as regular income that's spread out equally over the 3-year period from the date of the distribution for federal income tax purposes. Now, whether the states will follow that for their tax purposes, we don't know yet. And it's not entirely clear. It looks like you have to elect, if you don't want it to be spread equally over 3 years, you could elect to include it all in income in 2020. So there's some decisions that people will have to make if they decide to take these distributions. Next slide. So those are the general rules about distributions. And so they're very broad, they're very favorable, and there are definitely some reasons for employers to consider allowing them. One of the big things that employers need to understand is that these things are not required. They are optional, and it's not required that you allow the full $100,000. You could allow smaller amounts. You could allow amounts each month over the next, until the end of the year, so that people aren't hopefully making very rash, bad decisions and pulling a whole lot out more than they need or are able to either pay back or to pay the taxes on. So there are many reasons to step back and go a little slower, to consider putting other limitations on these amounts, just not allowing them broad-based for anybody. And of course, some of the record keepers are pushing back on that a little bit because they're, of course, overwhelmed trying to implement all of this in new systems. So if you don't kind of do the full allow everything, most liberal rule possible, it may take them a little while to get up everything programmed properly. But I still think that's better than us just opening the floodgates and letting everybody take out this money, because we all know there are challenges that people are facing as far as when they get to retirement already, and this is going to make that problem potentially much worse. So you might also decide to implement some of the loan option, which can be in addition to the withdrawal or can be instead of. And the loans also can be increased up to $100,000. So this is basically an increase of the current $50,000 limit up to $100,000, and the 50% of their account balance limit up to 100%. But if somebody already has, say, a $50,000 loan out, they can only get another $50,000 to get up to this total 100. They can't take this on top of the other. But when you start thinking about a $100,000 loan that has to be repaid over 5 years, that's a very sizable payment. So I'm not sure how valuable this will be to people, especially because the concern I have is that if they are able to make payments for a while, and let's say they start repaying the loan, and then it comes to 2021 or 2022 and they default on it, it doesn't appear that the 10% excise tax is waived in that case if they're younger than 59 and a half. So they, putting themselves in a position of being forced to repay the loan and then potentially defaulting down the road could be much worse than if they took out the distribution and they have the option to pay it back in a sense over 3 years. But if they don't, they're not going to be subject to that 10% penalty tax. So that's the reason why I think the loans provision may not be as desirable for employers as the distribution option, even though most employers are thinking, well, a loan's better because they're going to put the money back in for sure. But at least in this distribution option, they have the ability to put it back in, though how many of them will is, questionable. But so the big thing about loan provisions is that payments due in 2020 on not only loans currently outstanding, but any new loans taken for the rest of this year are the payments are delayed until 2021. They're basically pushed off a year from the date they would be due. All payments due in 2020 are pushed off to 2021. Now, what's not clear is whether this is mandatory if a participant requests it, or whether it's optional by the employer to offer it. So for right now, it appears that if somebody wants to push off their loan payments until 2021, that is mandatory. At this point, I would say that's the answer, but we'll need further guidance on that as well. Interest does accrue during this period, so there will be additional interest they'll have to repay, and the loan will essentially get re-amortized, but it's not re-amortized over the remaining 5-year period. They get an additional year, so now it's essentially like a 6-year period over which that loan can be repaid. To take into account the additional year. Next slide. So the 10% penalty tax part on this one is, to me, the most important thing to keep in mind, because if they default, now if they defaulted in 2020, could it be converted to a distribution in 2020 that would qualify for the waiver of the 10% penalty tax? I think that's possible, but once again, we don't have guidance yet, so I wouldn't be certainly advising participants that they could do that at this point. My guess is we'll get further guidance from the IRS relatively quickly because they know how urgent a lot of this stuff is. But once again, hopefully the urgency isn't so great because of some of the other things that are available under the CARES Act. Next slide. Plan amendments, we've definitely gotten questions about this. They are not required with respect to any of these changes until 2022. So you don't have to worry about having a plan amendment in place to offer these things, but you do have to have parameters about what you're going to allow and what you're not going to allow. So the two most important pieces right now are just to have some kind of policy, at least. This is the kind of distribution we're going to allow, or this is what we're going to allow as far as loans, and then to properly notify the employees. And I think this communication is going to be absolutely critical, because you certainly want to be discouraging people from taking money out of the plan in the first place, unless it is their absolute last resort. They should really be looking at every other alternative first. Okay, if there's nothing else, then they can go this route, and here's what the provisions are going to put on there. If you want to limit it to you know, a certain dollar amount, you want to put other restrictions on it, things like that should be included in this policy right now. And then the actual plan amendment will not be required until we get much more guidance from the IRS, and that will not be until 2022. So you don't have to worry about signing something formal at this point. Next slide. All right, so should you offer these new options? Next slide. Once again, I don't think you should be rushing to implement these or promoting them. Obviously, some employers are already getting questions about them, but you know, unfortunately, the market has continued to go down lately after bouncing up a little bit. Wouldn't be at all surprised if it continues to go down for another, you know, month or two, but that's anybody's guess. But we know it's already down significantly from a month ago. And so selling assets right now is generally not a good idea for most employees. So if we can find other sources of income for them to get them through in the short term, that would be much better. And then of course, there's all the unanswered questions that hopefully will get answered here. Next slide. Obviously, creating a potential future retirement income deficit by people pulling money out now is another reason that it's not advisable to rush into this. Next slide. So here's the way I kind of are spinning this for clients, is that having this available, and so if obviously employees would have to know that the employer is going to seriously consider implementing this later in the year, but a lot of employees are still contributing to their plans. Obviously, some are starting to stop contributions, but if they can understand that if things get worse and they really get bad, they will have the ability to pull money out later in the year. Hopefully, they'll continue to contribute right now out of this, whatever pay they're getting, whether it's additional pay through the CARES Act or the employer is just still making regular payments. Hopefully they'll continue to contribute, because we all know that if they don't, that's just only going to lead to more problems in the future. Next slide. Obviously, the participants who are really set up well, they've been saving, they've been doing all the right things, they have an emergency fund, they should be looking at a Roth conversion right now, because that's the time to do one, is after the assets have declined in value, because they're going to pay less tax on the conversion now than if they had done it a month ago. Next slide. The biggest thing that hopefully will come out of this crisis is that employees should not be using their retirement plan really as an emergency fund. They should have at least 3 months of income in some other conservative investment. And if they are going to use the plan as their emergency fund, which isn't horrible, I've got kids now that are working, and I've advised them that that's not a bad thing to do, but they especially if there's a match that they're going to be losing if they don't contribute before they have their emergency fund. But if they are going to do that, they should be doing it on a Roth basis, so that when they pull it out in a crisis like this, they have no tax and no penalty tax on that principal, even if it wasn't, the waiver wasn't in place. And that initial amount should be in conservative investments. So if they do have to pull it out in this kind of crisis, it hasn't gone down in value 30% or something. It's hopefully worth about the same amount that it has. And I see very few plans that are set up this way, so that until employees get a certain dollar amount put into something conservative and hopefully on a Roth basis, then it converts it to them putting them into a target date fund, something like that. Because when you think about target date funds, is even though they do have some portion of the money in bonds, if you have to sell them now to take it to withdrawal, you're selling predominantly stocks. So you are locking in a loss. So that's definitely something to be thinking about once we get through all this crisis. Next slide. Okay, the other provisions of the Act. Next slide. Minimum required distribution requirements for defined contribution retirement plans, not defined benefit plans, and IRAs are waived for the 2020 plan year. So no minimum required distributions have to be made this year. just like what happened in the 2008 downturn, give you an extra year. Hopefully the value of the account comes back up when people have to, before they have to contribute or make a distribution, but also they're not required to take a distribution based on that higher value as of the end of 2019. You'll look at the value at the end of 2020 and hope, and if it is still lower, at least you don't have to take as much out of the plan. And then defined benefit plans get some funding relief as a result of the downturn. And so that's a good thing as well, though it's only going to make those plans, you know, are going to have a lot of issues going forward, as well as multi-employer pension funds that have been in very bad shape already are now going to be only in that much worse shape as a result of all this. Next slide. So the other thing that employers need to think about is their employer contribution to their retirement plan. Unfortunately, many of them have had to reduce or eliminate those. That may be the prudent thing to do right now. Remember, if you're a safe harbor plan, you've got 30-day advance notice requirement to do that. But the nice thing is, because of the Secure Act that that passed at the end of 2019, you do have the option. Let's say you're currently a safe harbor non-elective plan and you decide to stop the non-elective contribution with 30 days advance notice. Well, now you're no longer a safe harbor plan. You have to do non-discrimination testing on the deferrals. You still have the option by December 1st, 2020 to make a new election to be a safe harbor plan, to make up the 3% contribution for the period that you, after you stopped them, and be safe harbor for this year. So it's not a bad decision to make, because you really don't lose, the ability to be safe harbor, and yet if things don't get better, you've cut off that liability fairly early. So that's definitely something to consider. If you do the safe harbor match contribution, you still have the advance notice requirement to stop it, and you will not be able to restart the safe harbor match for this year. You would have to wait until next year to do it, but you still would have the option to then be a safe harbor non-elective plan for this year if, whereas we all hope, things get much better later this year. Next slide. All right, well, that's a quick summary of everything. It's 9 o'clock. I don't know, Tripp, if you want to take any of the questions that you got.
Yeah. So it's 9 o'clock. We'll stick around for a few minutes. I've been trying to answer as many questions as possible in writing through the question and answer portal as possible. I have one question that I seem to get a number of times, so I will address that live. And then Frank, there's a couple questions for you that I'll read off and allow you to address. The question that I got a number of times is whether the required COVID-19 diagnostic testing has to be provided out of network without imposing participant cost sharing. And the answer is it is unclear at this time. Nothing in the legislation discusses any differences between in-network or out-of-network. We would hope that the Department of Labor Internal Revenue Service would issue additional guidance on that here relatively soon in the future, but we know they are extremely busy issuing guidance on a number of different fronts. So this will be a decision that will be left to the plan sponsor or the employer. We recommend that you consult with your legal counsel, or alternatively, the conservative approach would simply be to waive the participant cost sharing for the required covered diagnostic testing on the out-of-network basis too. So Frank, moving over to you, if it's helpful to you, I'll just read off the questions and allow you to address.
Okay.
So let's see.
Actually, I see him.
First one here is we have, are there any changes to 401k hardship withdrawal documentation for FEMA disasters or to the requirement for loan option to be taken before the withdrawal at this time?
So there is no requirement now as a result of the really prior regulations to have to take a loan before the hardship withdrawal, whether it's a regular hardship or it is the new COVID hardship. You do not have to mandate that somebody take a loan before that.
Next question.
And the thing,
oh, I'm sorry. Go ahead.
I was just going to say, so keep in mind that even if you have loan policy in place, you can now deviate with respect to these new provisions, but you don't have to. If people have a loan outstanding, you have a policy that says you only can have one loan, you can stick to that and not allow anything, none of these provisions other than potentially the deferral of loan payments for 1 year are mandatory. So you have the option to do these things, but are not required to.
All right, thank you. Next question is, are distributions from ESOPs exempt from the 10% penalty as well?
Yes, at this point, they could qualify as well for COVID distributions. As far as, the big question is whether if people were not otherwise eligible for a distribution under the terms of the plan, could they get one? Because the provisions of the law seem to be referring only to 401k, 403b, and 457. So 401a that would generally apply to employer contributions, whether it's an ESOP or a profit sharing plan, it is not entirely clear that those are, meaning that there's now an exception and you can give a distribution to somebody who's not otherwise eligible. But if they are otherwise eligible, even under the terms of the plan as it currently exists, then they should be exempt from the 10% excise tax.
All right, next question. If our 401k loan policy only allows for one loan at a time, does the CARES Act mandate we allow additional loans?
No, it does not.
Does the RMD apply to inherited IRAs?
So normally, there are required minimum distributions. Anyone that's required for 2020 should be deferred until 2021. I don't see any exception in there that applies to inherited IRAs.
Last two questions we have are more administrative related. Yes, these slides will be available on Miller Johnson's COVID-19 website. However, I do not believe that the question and answer dialogue will be available after the webinar. Greg, it looks like that's all the questions we have. So at this point, we will end this webinar. Again, we thank you for joining us, and we invite you to join our partners or colleagues, Sarah Willie and Sandy Andre, tomorrow morning as they again address some of the the hot topics in as far as questions related to employment issues with respect to COVID-19. Thanks everyone and have a good day.